All right, midweek market update video. It's Wednesday, November 6th, post election day, election hangover day. I stayed up way too late. I'm tired. I need a nap, but I really want to get this out. And I was just thinking about what what has the market been trying to digest with this change? Anytime there's changed, Wall Street's trying to digest what's happened and what they think is going to happen, and they start trading that, whether it's stocks or whether it's in bonds. Um, and there's also been some talk about that. I've been noticing some chatter about political trading, and there really isn't too much merit into it. Is it there? It's totally there, but I don't think it's still the market mover. So, when we've been hearing about people waiting for the election to take place, it's really hard to read into that and go, oh, that's totally true. The election is going to have such a major effect on interest rates. To say there's no effect is not true, but there's a bigger picture. There are bigger forces at large here that are moving markets. I want to address that a little bit more detail. So that way, as you talk about it, whether it's with friends or if you're a real estate agent for your client, loan officer with clients, just want to put a little commentary onto what's going on. So what I'm showing you right here is the value of a bond, of a mortgage bond, without going into major detail, but the value of a mortgage bond. And how this works is this: as Wall Street investors buy more mortgage bonds, the value of the mortgage bond goes up. And when they sell off mortgage bonds, the value of the mortgage bond goes down. And there's an inverse relationship between the value of a mortgage bond and interest rates. So if the value of a mortgage bond goes down, interest rates go up. If the value of the mortgage bond goes up, interest rates go down. What we're looking at here, really, this chart's taking us back to 2023. I really think we should just look at what's going on in the past 3 months so we can go all the way back to August. And we can see where we peaked, where rates actually were their best this year. We got to the low sixes. And this was really the height of the value of mortgage bonds in 2024. Since the Fed cut their rate, and this is no surprise to anybody, rates have moved up since that Fed rate cut. It was pretty minimal uh, drop in value in mortgage bonds. They did go down afterwards, but then it really got dramatic. Very quickly, we saw a drop in the value of the mortgage bond, which is why we saw a dramatic increase in interest rates. And it all circulates around the Fed's fight against inflation, going all the way back to why we started this whole thing. It all circulates around inflation. The Fed's trying to bring inflation down. And unfortunately, we've seen in several reports now inflation is leveled off. We're not seeing that that deceleration in inflation. We're also seeing fewer cracks in employment reports as well. And so that's Wall Street's feeling like the Fed's going to take a little bit of not quite a pause, but maybe a slowdown on their rate cut cycle. Now, before we jump into the Fed real quick, I do want to address what we've seen right here, right around the election. So this was the day of the election, November 5th. You see right there, this is the close. We actually saw an improvement in rates because we saw an improvement in the value of a mortgage bond. Truthfully and honestly, I just think that's more about what we call risk aversion. We had some probably traders who decided, you know what, I'm just going to buy some mortgage bonds. It's safe. It's safe to trade. A lot of talk about maybe Wall Street was trading in possibly a Trump win, and the talk is economists believe that a Trump win would be good for the stock market. It's a win for Wall Street, and if it's a win for Wall Street, it means Wall Street is going to buy stocks instead of buying mortgage bonds. So some talk there about maybe this is why this is happening. I don't necessarily think that's true. I think it really circulates around that inflation report we got last week that wasn't favorable. We got a few other reports last week that weren't favorable as well, that involved inflation with the goods and services, production of goods and services. So I think there's more to it than really when we're talking about the political value there. Now you can see, and we saw this. Maybe this is where we could see some of the trading on the winner of the election because the value of the mortgage bond went down. We actually saw the increase in the 10-year treasury yield. I'm not going to jump into that too much right now, but we did see some effect there. And as you can tell, we saw the value of the mortgage bond drop, which pushes rates up just a smidge, but we're not at where we were on Monday or Friday, November 1st. I think that was Friday. Apologize, I got that wrong. Friday, yeah, Friday was November 1st. So we're a little bit better than where we were, but nonetheless, we lost some ground that we had gained over 2 days prior. So as I mentioned, Wall Street's trying to figure out what the Fed is doing. Right? Their perception is what's changing interest rates. And they're not trying to perceive what's happening tomorrow, November 7th, by the way. Fed's meeting, they're going to be announcing most likely a rate cut of 25 basis points. Um, that's been kind of anticipated for quite some time. What really Wall Street is trying to figure out is what the Fed is going to do several months from now. When we were talking about June, July in previous videos, talked about June and July, we talked about rate perception of what was coming in September. It's not what's coming up in November, not even really December. I think really this is going to be even further out. Wall Street's already getting an idea that it's going to be a conservative rate cut cycle, no longer aggressive. This chart is going to show you how that perception has changed. Let me show you what I mean. This light bar here, this is 1 month ago. 1 month ago, Wall Street was thinking by March, we have a 58% chance that the Fed funds rate would be about 4% or 400 basis points. Since then, that thought process has changed. If we fast forward to 1 week ago, that dropped from 58 to 33. Yesterday from 33 to 26. And today it's at 16%. Where do they think we're going to be in March? Well, we went from, you see that the 425, so 4.25, nothing crazy, a quarter point difference. That's growing. And that's even shrunk a little bit because we're also seeing the probability of being at 4.5 growing. So instead of now you're seeing a half a point swing for March, which means maybe there's a pause in the mix somewhere instead of a rate cut. Maybe there's a pause. There could be a pause in a rate cut cycle. And if we take this out further, right? If we go and we look in October of next year, so a year from now, you can also see, look how the perception has changed of 3.5 for October and has dwindled down. And now and what's growing is being at 400 basis points. So this rate cut cycle, and this is a pretty wide range here too, by the way, that's only 30% probability. So as we get closer, the probabilities narrow, they get a little bit more specific. But what we're seeing is instead of a low, further out into the future, lower rates, significantly lower rates, we're going to see them less significant. They may be lower, but not by much, meaning this rate cut cycle is going to be drawn out. This is what a soft landing looks like, by the way. A soft landing means no unemployment's not broken, right? The job market's not broken. That means inflation will still be coming down. Um, and all this can be achieved without a recession happening. And that's what a soft landing is. And a soft landing means we will not see an increase in, or not increase, we won't see a significant decrease in interest rates. It's going to take a while for that to change. So there is, what I'm saying is there is no, hey, next month, 2 months, 3 months from now, we'll see rates coming down to 5%. Could it? It could most certainly happen. I mean, nobody knows the future. Nobody can predict the future. But if we're talking about what the Fed is looking at, why we've been experiencing these rates where they're at above 6%, in 7% for the past 2 years, is because this battle is ongoing. And Wall Street has been listening to the Fed. The Fed kept saying higher for longer, higher for longer. Then all of a sudden it was like, hey, we're going to start cutting rates. And Wall Street got excited. And now it's looking like maybe we got a little ahead of ourselves. Maybe we have to go back to higher for longer. And that's what Wall Street's kind of afraid of, is higher for longer. If it's going to be higher for longer, Wall Street's going to protect themselves. They're not going to buy mortgage bonds. They're going to go buy stocks. It's going to make them more money. If the Fed funds rate isn't going to be reduced, that means the cost of borrowing money is going to go up. And so the incentive just isn't there. And there's a few other things thrown into the mix besides Fed's funds rate. Obviously, government spending is an issue. Bond issuances are issues. There's a lot of issues out there, but one of the biggest ones is going to be the Fed funds rate and the cost of borrowing money. And that's what the Fed is using to fight inflation. So here's the thing. I don't want this to sound gloom and doom, right? But I want to be realistic. One of the biggest talks going back to last summer was, are we going to have a soft landing or are we going to have a crash? Right? A economic crash doesn't sound great. A recession doesn't sound great. A soft landing sounds great because now we're talking about people are not losing their jobs, and the battle against inflation is being won, and everything is going to be pretty much just as they were. The thing about for mortgage rates is not a great thing because that means if we have a soft landing, that means that Fed funds rate is going to be drawn out. That means these mortgage rates are going to stay higher. It stinks to say that, stinks to hear that. But here's the message. It's not the first time I've said this, but there's opportunity out there for real estate, especially when it comes to financing. We hear about the golden handcuffs all the time. And if you're not familiar with what that is, the golden handcuffs means you've got people that are in houses with interest rates at 2.5, 3.5, 4%, and they don't want to move because the rate's so good and their payment's so good. Well, they would like to move, but they can't. It's the golden handcuffs. They are handcuffed, but quite nicely. Like, you can't be upset about it. You got a really good rate, right? But sometimes, maybe someone bought a house that they didn't particularly love, but they bought a house because they needed to buy a house when the rates were good. They lost out on five other houses. So they've got this thing called the golden handcuffs. And there's so many people out there because they read the headlines, they believe that they can't make a move. They can't sell their house. They can't go buy a house because the rates are too high. The house is too expensive. And really, what it comes down to is just not being educated enough to understand how to negotiate properly. If you're selling, how do you negotiate properly to get your home sold? Not sold at the tip top of the market where you make the biggest paycheck that you could possibly get from it, but it's about how can we get it sold? And then as a buyer, get into the buyer market where you have all the power. This is a buyer's market right now where you can negotiate better terms, better rates. You don't have to live with a 7% interest rate, or your client doesn't have to live with a 7% interest rate. I'm getting people all the time, they're able to get lower rates, lower than the market rate, because they're able to negotiate better terms on their contracts because this is a buyer's market. This is it. So if we're talking about opportune time to purchase a home, this could be it. This could make a lot of sense. But those are where we need to have conversations and bring that up and find out what the goals and aspirations are for the home ownership dream. So, anyways, guys, hopefully this was helpful. If you have any questions, let me know. I'd love to answer them for you. Love to talk with you a little bit more about it. If I don't hear from you, I'll talk to you next week.